There's something Robinhood does not want you to know, but as your YouTube lawyer, you know I care about transparency, so I'm here to tell you everything. We're talking about how Robinhood really makes money and why their interests are more aligned with the hedge funds and market makers than people like us. I know that Robinhood is paying a lot more money to their influencers now because they've lost share to their competitors, and I can guarantee you that I will be blacklisted from Robinhood with what I'm about to tell you, especially at the end, so please pay attention until the very end and smash the like button. There are a lot of red flags here, so I'm going to tell you why I think it's worth diversifying your risks and reallocating your capital amongst different brokerages, or perhaps deleting Robinhood entirely. A few days ago, Robinhood prevented their customers from buying stocks like GameStop, AMC, Nokia, BlackBerry, and others in an act that not only made customers furious, but caught the attention of the media and members of Congress. So let's talk about what could really be happening behind the scenes here and the red flags I see. If it's your first time, I'm Erica Kohlberg, I'm a lawyer, and if you want to stay updated, don't forget to subscribe. Let's give some background about Robinhood. As of their latest funding round in 2020, they had around 13 million users on their platform, a figure that has likely only swelled since then. What initially began as an online brokerage that quite literally changed the game by providing access to millions of retail traders and by being one of the first to offer no commission trading, now faces a revolt. They're facing a lot of backlash now for their decision to block retail investors from purchasing stocks like GameStop. They've gone from having this image as a fintech innovator that helped make it possible for retail investors like you and me to easily invest in the market to one that now is seen as an online brokerage house that steals from the poor retail investors and gives to the rich hedge funds. Is that justified? Let's talk about it. Here are some things that you want from your online brokerage. 1, reliability. An online brokerage that is reliable when markets are busy is absolutely crucial. Historical precedent, however, has proven that at times of stress, Robinhood's platform has had difficulties in scaling to the capacity that was needed. A quick look at downdetector.com, which shows real-time and historical problem and outage monitoring of your favorite online services, shows that Robinhood has had 11 issues since January 25th and 18 in the month of January. This is not an issue you want to have when your hard-earned money is at risk. You also want fairness. An online brokerage, or any brokerage for that matter, should provide you with the ability to buy and sell securities without any form of interference from the brokerage. As we've become painfully aware, the benefit of providing a zero commission brokerage model implies that the source of revenue to Robinhood comes from selling data on retail investor flows to, you guessed it, hedge funds. While most brokerages make money by charging customer fees for everything from trading to financial advice, Robinhood's business model is known as payment for order flow. In other words, Robinhood's profits come from taking their customers' stock orders and selling them to larger trading firms who execute the stock, effectively selling your order flow to the highest bidder, which includes market makers and high-frequency traders. They, in turn, offload their position on the exchange, likely at an arbitraged profit. So if that didn't make sense, let me give you a more simple visual example. This is me at the top here. I want to buy a share of a stock from Robinhood. Let's say that's the strawberry. I want 1 strawberry from Robinhood. I see on the Robinhood app that it's selling for $1, so I pay $1 to buy it. Now, Robinhood has to fulfill that order. Robinhood doesn't actually have the inventory of strawberries, so they need to have a middleman provide the strawberry. This middleman, Citadel, is selling you the strawberry for $1, but that's likely not what they're actually buying it from the New York Stock Exchange for. They're likely buying it for cheaper. In this example, let's say 99.5 cents, which means that they've actually just made half a penny on your order. And if millions of people on Robinhood are buying strawberries, you can see how this quickly adds up. That act that Citadel is doing, by the way, is called market making. They are creating a market, and that's why you'll hear firms like Citadel and Virtue referred to as market makers. Now, Robinhood doesn't want you to know this. It's worth reminding you that it was just in December 2020 that the SEC fined Robinhood $65 million for misleading customers about revenue sources and failing to satisfy the duty of best execution. It is this idea of best execution that is crucially important to understand and what's at the center of Robinhood's payment for order flow business model. According to an article in the Financial Times, Citadel pays tens of millions of dollars for this order flow, but makes money by automatically taking the other side of the order, then returning to the market to flip the trade. It pockets the difference between the price to buy and sell, known as the spread. So again, using our strawberry example, what this means is Citadel is the one making, let's say, half a penny for every single time someone buys a strawberry on Robinhood. They're taking a spread. So what's in it for Robinhood? Where is Robinhood making money? Robinhood is making money by selling Citadel and other market makers access to you. This is called buying order flow. Citadel and other market makers are paying millions and millions of dollars to Robinhood. So Robinhood's customer is not actually us, the retail investors. No, Robinhood's customers are the hedge funds and market makers that pay them for this access to you and me. And we are the products. Let's think about this. If Citadel and other market makers are able to pocket the spread to buy and sell, that means that you, the investor, are paying the wrong price from the beginning. That strawberry you bought on Robinhood for $1 is actually only worth, let's say, 99.5 cents. And Citadel can sell a strawberry to you for $1 and buy it back in the market for 99.5 cents, pocketing the half a penny spread. This is the basis for market making and hinges on the fact that they are able to do this over and over and over again. The more interest there is in retail investing, the more market making opportunities there will be. The more volatile a stock or market is in general, the wider the bid-ask spread will be. Think GameStop, leading to potentially higher profits for the market maker. This is directly from the SEC. Robinhood failed to seek to obtain the best reasonably available terms when executing customers' orders, causing customers to lose tens of millions of dollars. In fact, the SEC says this cost customers $34.1 million even after taking into account the savings from not paying a commission. Citadel is a private company, so disclosure and details from them directly are tough to come by, but Virtue, another market maker similar to Citadel, is public and offers clues on the profits that are there for the taking. In the first quarter of last year, earnings from market making, that's the spread, which in Virtue's case included retail and institutional orders, jumped 267% from the same period before to $652 million. Money spent on buying order flow, and again, that's paying apps like Robinhood for access to customers like you and me, increased much less, up 167% to $62 million. It's clear that retail market makers are getting increased trading volume. They are likely also getting increased profitability per trade. This leads me to my third point, conflict of interest. And this is when it gets really crazy as you realize how this all plays into the GameStop and AMC story. As we talked about earlier, what began as a movement to shift away investors from the high commission-paying brokerages into the zero commission-paying model was accomplished ultimately at the expense of retail investors. How? Well, the conflict of interest highlighted earlier through the payment for order flow business model is problematic for retail investors because they get the worst end of the deal. Not only are they likely paying more than they should be to buy each stock, but then the major issue here is what we need to talk about, which is who is Robinhood's ultimate fiduciary? Even though Robinhood claims to offer investing for everyone, their business model says otherwise, because they're not being paid by the retail investors like you and me. They're being paid by the hedge funds and market makers. The Reddit community and the flock of retail investors have become painfully aware that the fiduciary may, in fact, have been the end users who ultimately pay Robinhood's bills. I'm talking the high-frequency traders and hedge funds, not us. Robinhood's disclosures as of October 2020 show that it routes more than half of its customer order flow to Citadel and Citadel affiliates, by far its largest market-making partner by volume. In the table on the screen, it's worth noting that 2 Sigma is the quant hedge fund owned by Citadel. Reddit users accuse Citadel founder Ken Griffin of pressuring Robinhood to limit trading of certain stocks, a move that may have prevented further losses for the short sellers that lost billions betting against GameStop. To add to this, you should note that Citadel was part of the consortium of high-profile hedge funds that bailed out Melvin Capital, a WallStreetBets target, in its battle against day traders. Now, of course, Robinhood has a defense. Their CEO was questioned by Elon Musk on Clubhouse last night quite directly about whether their decision to shut down trading of those names was at all influenced by Citadel. Their CEO said no. He explained that essentially it was a liquidity issue, and that's why they had to restrict trading and raise an emergency $1 billion. Robinhood needs to post collateral with their clearinghouses, and the outsized volatility they say caused them to have to post a lot more collateral than they had available. Even if that's the case, there are still some issues here. One, there should have been clearer communication and transparency with the customers from the beginning. When asked why they had to raise $1 billion, Robinhood's CEO responded,
"Well, look, I don't really want to get into the details of exactly what happened when."
Another issue is that if true, this was a business miscalculation that came at the expense of customers. VAR, which is value at risk, is a calculation that essentially determines how much collateral Robinhood needs to put up for settlement and clearing of its trades. And it is something that can be modeled for. And the question is, to what extremes were they modeled? It seems like here, they hadn't modeled for the worst case scenario, which is the whole reason you're supposed to model for value at risk so you don't run into these kinds of issues. So here's my question to you, and let me know in the comments what you think. Was this a coincidence or red flag? When Robinhood shut down the ability to trade in 13 names like GameStop and AMC, did it show its true colors, that it was more concerned about protecting its own business than doing right by its customers? We already know from Robinhood being fined $65 million by the SEC just last month that they haven't been transparent in the past. So how could we expect different behavior this time? Now let's talk about why you need to consider other alternatives. The number of red flags being raised here continue to grow, and in the interest of protecting your capital, you must consider other alternatives. These cross-dealings show how complicated and potentially rigged the system is. I'm not a financial advisor, just some lawyer with a YouTube channel, but I'd maybe look at diversifying your capital to multiple brokerages, and perhaps in the process, pulling your money out from Robinhood entirely. That way, if they shut down trading again, or another outage occurs, or they continue to have liquidity issues, which is never a good thing for a company that has your hard-earned money, you'll still be protected and still be able to trade places. And if you want a good alternative, you can click on my link to SoFi Invest, which is a platform that I'm using. And if you enjoyed this video, don't forget to hit the thumbs up and subscribe. Thanks for watching.